Warren, how would you define true success?
Well, I've said many times that if you get to be 65 or 70 and later, and the people that you want to have love you actually do love you, you're a success. I've never seen anybody that reaches that age. I mean, I'm not...
Investing sounds complicated, but it doesn't have to be. Imagine having your money grow while you sleep. That's what good investments can do for you. Whether you're saving for retirement, building wealth, or preparing for your family's future, today we'll explore the foundations of smart investing. We'll break down key strategies that can turn financial jargon into simple, practical steps you can start using right now.
In 1942, 80 years ago, I took $114.75 every penny I'd saved, and I bought 3 shares of City Service Preferred, and City Service is a pretty well-known name.
Understanding investment basics. To start, let's define investing. At its core, investing means putting your money into something with the expectation that it will grow over time. You're essentially buying a piece of a company, property, or even an idea in hopes that it will increase in value. Types of investments. Stocks. When you buy a share of stock, you purchase a small part of a company. For instance, if you invest in Apple, you own a tiny piece of that tech giant. Stocks can be volatile but offer the potential for high returns. Real estate. Investing in property can provide rental income and potential appreciation in value. For example, purchasing a rental property can generate cash flow while also increasing in value over time. Mutual funds, or ETFs. These are pooled investments where multiple investors contribute money to invest in a diversified portfolio of stocks or bonds. An example is the Vanguard Total Stock Market ETF, which allows investors to own a piece of the entire US stock market. Each type comes with varying levels of risk and reward, which is why it's important to understand where you're putting your money. You're not just saving, you're growing your wealth long-term versus short-term investments. When investing, one of the key decisions you'll make is whether to pursue long-term or short-term goals. Long-term investments typically involve a buy and hold strategy where you expect your money to grow steadily over years or even decades. These include stocks, bonds, and real estate. Long-term investment example, consider an investor who buys shares of the S&P 500 index in 2000. Although the market experienced downturns like the dot-com bubble and the 2008 financial crisis, the investor holds onto their shares. By 2024, the S&P 500 has significantly recovered and grown, illustrating the power of long-term investing. Short-term investments focus on generating quicker returns. These are generally more volatile and might involve frequent buying and selling of assets. A common mistake is trying to chase quick profits through day trading or short-term speculation. While it can work, it's a gamble and often leads to more losses than gains. Short-term investment example, imagine an investor who buys stocks based on recent trends without doing thorough research. If they buy shares of a popular tech company during a peak, they may experience immediate gains. But when the market corrects, they could face substantial losses if they sell in a panic. The psychology behind long-term investing is crucial. As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. Patience allows time for growth and helps you avoid panic selling during market downturns.
Well, a Berkshire Hathaway shareholders meeting is partly a class in business. It's partly a fun festival. It's sort of a Mardi Gras for people that come every year. It's a chance for us to have a lot of fun and meet the people.
Diversification. Don't put all your eggs in one basket. Diversification is one of the most important principles in investing. This strategy involves spreading your money across different types of investments to reduce risk. It's the financial equivalent of not putting all your eggs in one basket. If you only invest in one tech stock and that company faces a scandal or drops in value, your entire investment could plummet. However, if you diversify by investing in various sectors, like technology, healthcare, and consumer goods, you're less likely to experience significant losses. For instance, if your tech stock drops, gains in a healthcare stock could offset those losses. Real-world example, imagine you invested all your money in a tech company like Facebook or Amazon in 2022. When the market took a downturn, those stocks dropped significantly. However, if you had also invested in other sectors like utilities or healthcare, you would have mitigated your losses. As financial advisor Benjamin Graham stated, the essence of investment management is the management of risks, not the management of returns. Diversifying protects your investments from volatility and potential losses. The psychology of investing, managing emotions. Investing is as much about mindset as it is about numbers. It's easy to get caught up in the emotional highs and lows of the stock market. When markets are booming, it's tempting to buy more, and when markets crash, the instinct is to sell. Successful investors manage their emotions by sticking to their long-term plan. Research shows that impulsive decisions driven by fear or greed are one of the biggest reasons people lose money. By understanding that the market will have its ups and downs, and by staying focused on your goals, you can avoid making costly mistakes. Real-life example, take the 2008 financial crisis, for example. Many investors panicked and sold off their investments, locking in their losses. However, those who stayed patient and continued investing came out stronger when the market rebounded in the years following. The lesson here: consistency and patience pay off in the long run. As author and psychologist Daniel Kahneman noted, losses loom larger than gains. This means that the fear of losing money often drives investors to make hasty decisions. Recognizing this psychological bias can help you stay disciplined and focused, the risk-reward trade-off. Every investment comes with risk, and understanding the balance between risk and reward is critical. Higher risk investments, like stocks, offer the potential for greater returns but also come with the possibility of losses. Lower risk investments, such as bonds, provide more stability but generally offer smaller returns. Knowing your risk tolerance, the level of risk you're comfortable with, is important in building your investment portfolio. A younger investor might take on more risk because they have time to recover from any losses. An older investor nearing retirement might prefer more conservative investments. Example of risk-reward. If you invested in a high-growth tech startup, your potential for high returns is substantial, but the risk of losing your entire investment is also significant. Conversely, investing in government bonds offers lower returns but with minimal risk. It's all about finding the right balance that aligns with your financial goals and timeline. The key is to not chase unrealistic returns or be afraid of market corrections. Slow and steady wins the race. Real estate investment trusts. Real estate can be an excellent investment, but not everyone has the capital or desire to own physical properties. Enter real estate investment trusts, REITs. These are companies that own, operate, or finance income-producing real estate. Investing in REITs allows you to buy shares in real estate without the responsibilities of being a landlord. Example of REITs. You can invest in a healthcare REIT that owns and operates hospitals, or a retail REIT that manages shopping malls. These companies typically pay dividends, providing a source of income for investors. Real-life example, in 2020, many REITs experienced fluctuations due to the pandemic, but some, like those focused on healthcare properties, continued to perform well. This illustrates the importance of diversification within your investment strategy, as some sectors may thrive during downturns. Investing in REITs offers a way to gain exposure to real estate markets while enjoying the benefits of liquidity and diversification that come with stock investments. Investment strategies: value versus growth investing. Two popular strategies in the investing world are value investing and growth investing. Each has its own approach and appeal. Value investing. This strategy involves looking for undervalued stocks that have potential for growth. Value investors like Warren Buffett focus on companies that are trading for less than their intrinsic value. Example of value investing. If a strong company's stock drops due to market fear, a value investor might see an opportunity. For example, if Coca-Cola's stock falls due to temporary issues but has a solid business model, a value investor would consider this a bargain. Growth investing. Growth investors look for companies that are expected to grow at an above-average rate compared to their industry. These stocks typically reinvest profits into the business rather than paying dividends. Example of growth investing. Companies like Tesla and Amazon have been popular among growth investors due to their rapid expansion and innovation. While these stocks might be more expensive, the potential for high returns is significant if the companies continue to perform well. Both strategies have their pros and cons. Value investing may offer more stability but requires patience, while growth investing can yield high returns but often comes with higher volatility. Staying informed, continuous learning investing is not a one-time event. It's a continuous learning process. Markets evolve, new opportunities arise, and economic conditions change. Staying informed is crucial for successful investing. Ways to stay informed: read financial news and publications such as the Wall Street Journal or Bloomberg. Follow investment blogs and podcasts that provide insights and strategies. Consider enrolling in online courses on platforms like Coursera or Udemy that focus on investment strategies and financial literacy. An investment in knowledge pays the best interest, as Benjamin Franklin said. The more you learn about investing, the better equipped you'll be to make informed decisions. The dangers of compounding interest in unethical investments. Investing sounds complicated, but it doesn't have to be. Imagine having your money grow while you sleep. However, not all growth is beneficial, especially when it comes to the compounding interest associated with harmful financial practices. While compounding can work wonders for investments, it can also lead to dangerous outcomes if applied in the wrong contexts, such as high-interest loans or investing in unethical companies. The risks of compounding interest. When it comes to debts, compounding interest can quickly spiral out of control. For instance, if you take out a high-interest payday loan, the interest can compound rapidly, leading you into a cycle of debt that becomes increasingly difficult to escape. What starts as a manageable loan can turn into an overwhelming financial burden, as the interest adds up faster than you can repay the principal. Investing in unethical companies. Similarly, investing in companies that engage in harmful practices, such as those in the alcohol, gambling, or tobacco industries, can also be risky. These companies may promise high returns, but their practices can lead to societal harm and even regulatory backlash. As an investor, your money helps sustain these businesses, and the compounding profits may come at a moral cost. Over time, this can lead to reputational damage and potential losses as consumer sentiment shifts against such companies. A balanced approach. While compounding interest can be a powerful tool for growth, it is crucial to recognize its potential dangers when associated with high-interest debts or unethical investments. By being mindful of where you invest your money and understanding the implications of compounding, you can make more informed decisions that promote financial stability and ethical responsibility. Always prioritize investments that align with your values and contribute positively to your future and society. If you found this video helpful and want to learn more about personal finance and investing, don't forget to subscribe and hit that notification bell. Share this video with anyone you know who might benefit from understanding investments better. And let me know in the comments, what are your biggest investment questions? Let's tackle them together. Remember, making smart choices today can lead to a more secure and prosperous future.